Right, this is the episode for the mitigation block. So you'll see it on some people's charts as MB, but that's just short for mitigation block. So a bullish mitigation block is characterized by a swing low, then a failed swing low, a push higher, creating a market structure shift, and that will create the mitigation block. To trade it, you then wait for a retracement back to the mitigation block, and then it will proceed higher. A bearish mitigation block is the opposite, a swing high, failed swing high, and a market structure shift, and then retracement to mitigation block, and then proceeding lower. One key note for everyone here. So after this, obviously you're going to go and look for mitigation blocks, right? This is the same for another block called a breaker block, and this is going to be covered, I think, in the next episode. When looking for them, just look for a market structure shift, because you can only find mitigation blocks and breaker blocks at a market structure shift. They do not occur anywhere else. That is what confirms a breaker block or a mitigation block. There has to be a market structure shift. Without that, there's these two arrays don't exist, right? So when going back and looking at your charts, just look for where price is going lower, and then there's a market structure shift, and it starts to go higher. There will be your one of those arrays. At a market structure shift, there will always either be a mitigation block or a breaker block. So continuation of the characteristics. The mitigation block you mark out will be, so a bullish mitigation block is the failed swing low. That move is considered the mitigation block. Right, so that failed swing low, that whole move is the mitigation block. The bearish mitigation block is the swing high. That move is considered the mitigation block. Now, what do I mean? So here you see we are having an uptrend categorized by higher highs and higher lows. Pretty simple. Now after this higher high, we get a higher low, simple, and then we get this failed swing high where it fails to break, right? And then we proceed lower, creating a market structure shift. This basically means instead of another higher low, we have a lower low. So it's higher high, higher low, higher high, higher low, lower high, lower low. The lower low after the higher low, that is the market structure shift, right? Now, after this market structure shift and a candle has closed, this whole move, this whole failed swing high is the mitigation block. You will then wait for price to retrace. This is called a retracement. These are all retracements, just in case you didn't know, right? Price retraces back to the mitigation block, and then it will proceed in its intended direction, right? Now, opposite is true for a bullish scenario. We have bearish structure, right? Lower low, lower high, lower low, lower high, until we get a change in character, right? We have a higher low instead of a lower low, failed swing low. We then have a higher high. It's not a lower high, higher high, right? Market structure shift. This then causes the mitigation block. Price will come back to it and trade away. Now, not every time the price will come back to the mitigation block. We will look at where price is likely to come to, but after you've learnt the arrays and the PD array matrix, you will come to spot where price is likely to go to and where price isn't likely to go to. Now, obviously, you can't get it 100%, but you can get quite accurate. A real world example would be, so this is a high, here we have low, we have a little bit of consolidation here, but this is a failed swing high, and then we break lower, right? So before this would have been an uptrend. We have this, break lower, market structure shift. This candle breaks that, right? We then come back up, retrace. This green box here, this is the mitigation block. These two green up candles. Now you count both of them and you include the wicks. Price can come anywhere within this and then reject off. Okay? Remember, price comes back to refill inefficiencies. It also came to fill this fair value gap paired with obviously this mitigation block, and then explosive move. Bullish example, right? We have low, high, failed swing low, market structure shift with this impulse. Price comes back down and then shoots away, right? What does price do after rebalancing inefficiencies? Seeks liquidity. All right, let's have a look at some real world examples. Bear with me, I'm trying to get like a kind of a clear cut one. DXY has been awful recently, I might have to go back. Yeah, so here, swing high, failed swing high, right? Price breaks down. Price, hold on, let me just mark out for you. Just quickly, here, where would you mark out the mitigation block? Just have a little go. It would be marked. Now, obviously, it's a sticky one before with this down close candle, but essentially, if you were to go up a time frame, that would all just be one move, right? So that's what you would consider the mitigation block. Price comes up to it, and now if we draw out our fib, see how price comes into the OTE zone quite nicely and then rejects away, right? That's sort of how you would use it. And this is obviously the 4 hour, right? So you wouldn't, this is not for entry. Was this the 20th of November? I couldn't even remember that far. Okay. But yeah, let's say this was the 15-minute. This is something that your profit loss would look like, right? You take it roughly here, probably at the start of there, right? So it'd be like something like a 2 hour. That's sort of how you would frame a trade off of a mitigation block. Now I would like you lot to go and look at some yourself and send me them when you get them.